Good afternoon, everybody. And I, on behalf of Women and Young Members Excellence Committee, welcome you all in this virtual series on Unleash Your Potential, Learn, Upskill, and Excel. This series is one of Women and Young Members Excellence Committee's initiative to augment the knowledge and overall confidence building of the members presently working in the industry, but aiming to switch to practice, members who are on career break but want to resume their professional career, or members aiming to widen their area of expertise in respective professional domains. This series will also be helpful for the members at large in enriching their knowledge and overall confidence building by keeping them abreast with the latest amendments in diverse fields. Today, we are going to cover sessions on profits and gains of business or profession, provisions, deductions, disallowances, presumptive taxation, and how to fill in ITR, which is very important these days because so many things are coming up and the integration of technology with all the taxes and their portals. So for today's session, we have with us CA Sonali Godbole with us. Ms. Sonali Godbole qualified as a chartered accountant in 1997 with 28th all over India rank. She also cleared her LLB exams in year 2001. She practices in the area of direct taxes for past 25 years and is a partner at Kalyaniwala and Mistry LLP Chartered Accountants. She's a member of Taxation Committee and Journal Committee of the Bombay Chartered Accountants Society. She's also written articles in Outlook magazine, IT Review journal published by Chamber of Income Tax Consultants. She's also co-authored books on ICDS and TDS published by the Bombay Chartered Accountants Society, and she's been speaker for seminars organized on the various topics of direct taxes. She also has been a visiting faculty for taxation in JBI, MS and Wellington Institutes of Management, which are really one of the premier institutes, undoubtedly. And I'm pretty sure that we have an apt speaker for today's session as Sonali ma'am with us. With this brief introduction, I welcome you to this forum, ma'am, and I request all our participants to welcome you with a digital smile. Welcome to the forum, ma'am.
Thank you, Swarupa. Can we start the session?
Yes, ma'am. Yes, ma'am.
Okay. Good afternoon, everybody. The topic for today is the head of income called profits and gains of business or profession. Now, as you all know, the Income Tax Act divides income under 5 different heads, and each head of income has its own unique method or code to calculate how the income under a particular head will be computed. And as you know that it is important to calculate income or compute income under a particular head because the provisions for calculating the income, the available deductions, etc. for each head of income are different. And therefore, the deductions which are available under the head profits and gains of business will certainly be different than the head of income from other sources. So as a first step, it's important to identify what is going to be taxed under the head profits and gains of business. And then the next step is how to correctly calculate the income under the particular head of income. So today, in today's sessions, we are going to discuss and deliberate upon how to deal with the topic or the chapter of profits and gains of business or profession. So let me share the screen. Yeah. So once we are starting with this head of income, just a minute. Yeah, can you all see my screen?
Yes, ma'am.
Yeah. Okay, so now we are going to start with, Now, sections 28 to 44 DB are the sections which deal with computation of the head of income under the head profits and gains of business. And if we were to broadly classify as to how these sections are or what the arrangement is, section 28, which is the first section of this whole scheme, is about the chargeability, which shows as to which incomes are going to be taxable under the head profits and gains of business. Section 29 says how will you do computation of income under this head. Then there is a series of deductions. Section 30 to 36, section 38 are the specific deductions for each particular head of expense. Apart from these specific deductions, there is a general deduction in form of section 37. Then there is section 40, which says that which are the amounts which are not allowed as a deduction. Section 40A also talks about the expenses which are not deductible in certain circumstances. Section 43B, which is an important section, which talks about deduction only on actual payments. Then there are specific provisions which are in form of giving the definition or meaning of a particular word which is used in the chapter, which are various sections of 42, 43A, etc. Then comes an important block of sections which are presumptive taxation, section 44 AD, ADA, AEB, BBA, BBB, etc. Then last two sections in this chapter are about maintenance of books of accounts and when is audit of accounts necessary. So this is the general scheme of sections under which the topic of profits and gains of business can be divided. Now let's first understand what is taxable under the head profits and gains of business. As the heading suggests, any income from business or any income from profession will be taxed under this chapter or this head of income. So what is the definition of business? So definition of business is given under section 213 of the Act, and it says that business includes any trade, commerce, manufacture, or any adventure or concern in the nature of trade, commerce, or manufacture. And therefore, this definition is an inclusive definition which refers to any commercial activity which a person may undertake. And the word which says about adventure or concern in the nature of trade, commerce, or manufacture means that even a singular transaction made with the intention of profit motive can be taxed under the head profits and gains of business. So there need not be a series of transactions. Even a single transaction can lead to business income. The definition of profession, which is given in 236 of the Act, also is an inclusive definition, and it says that profession includes vocation, and therefore any amount of income derived from any profession or vocation is taxable under the head profits and gains of business. Now, having said this, let's come to section 28, because 28 is a chargeable section and it gives a list of items which will be taxed under the head profits and gains of business. The first item says that any profits or gains of any business or profession which is carried on by the assessee will be taxed under the head profits and gains of business. So it's a simple meaning of the sentence that any profits from business or profession will be taxed here. Second point is that when there is any compensation or other payment which is due or received for modification or termination of an agency or in connection with nationalization of business or property, or modification to the existing terms and conditions of contract. So if there is any lump sum or a periodic compensation received for such activities, even that income is chargeable to tax under the head profits and gains of business. Next says that any income derived by any trade, professional, or similar association from specific services performed for its members is taxed as business income, which means any trade organizations which is formed for protecting interest of particular trade, say cotton manufacturers trade association, it could be milk cooperative society. So any such organization formed for providing services to its members, and any income which is derived by such association is taxable under the head profits and gains of business. Then profit on sale of import entitlement licenses, which are allotted when you are into import export of your products. Any profit is chargeable to tax as business income. Cash assistance received by exporter, or any duty of custom or excise repaid, or any refund received as drawback is also taxable as business income. Any profit on transfer or sale of a DEPB license is business income. 9, the value of any benefit or perquisite, whether convertible into money or not, arising from business or profession is also taxed. Now, this is the amendment which has come in the Finance Act 23, which says that any benefit which a person receives, there is lots of background noise. Can somebody mute that voice, please? Yeah, the value of any benefit or perquisite which a person would receive during the course of carrying on of his business is taxed as business income, irrespective of the fact that whether that benefit or perquisite is convertible into money or not. It may not be able to convert into money. It may be in kind, or it may be partly in cash, partly in kind, but such value of that benefit will be taxed as business income. Any interest, salary, bonus, commission, remuneration, by whatever name you may call it, received by a partner from the partnership firm is also taxed as business income. So mind well, the salary received by partner is not taxed under the head salary income, but it is taxed under the head business income. Point number 11. Where any amount is received by a person under an agreement for not carrying out any activity, for not sharing any know-how, patent, copyright, is also called or taxed as business income. It is something in the nature of non-compete fees. So you are paid a lump sum amount for not carrying out the business activity within a particular region, or for not sharing the patent with any third party. So you have taken the patent of the product from the person who has created the patent. Apart from paying him for use of patent, you also pay him a lump sum amount so that he does not share that patent with any third person. So such a lump sum amount received, lump sum or otherwise, received by the person for not doing a particular activity, it's a negatively coined term, is also taxed under the head business. And amount received under a keyman insurance policy, which a business takes for its partners, for its directors. So keyman insurance policy, including the bonus amount which is received by the business, is chargeable to tax as business income. Point number 13 is also a recent amendment of last year, which says that when there is any conversion of inventory into fixed asset, into capital asset, then such conversion will also become taxable under the head business. And what would be taxed? The market value of that inventory, which will be calculated as per rule UAB, will be taxed as business income. Earlier, we had a provision that when a capital asset is converted into stock in trade, the gain arising on that was taxable under the head capital gains. But there was no provision to tax when inventory was converted into a capital asset. So last year, an amendment was brought into the act to say that any profit arising from transfer of inventory into capital asset is also chargeable to tax under the head business income. And the last amount is any sum received or receivable by a person on account of any capital asset which is demolished, destroyed, or transferred. If the original expenditure for acquiring that was allowed as a deduction under section 35 AD. So the logic is that when you acquired that asset, you got a deduction of that entire amount under 35 AD. And therefore now when you receive any amount on destruction, demolition, transfer, discarding, etc., that amount gets fully taxed under the head business income. So these are the items which will be taxed under the head profits and gains of business. So that is the starting point for calculating income under the head profits and gains of business. Now let's come to the second part. Once you know what is going to be charged to tax under the head business income, the next is logically to understand that what are the deductions which are available to a person when he is offering income to tax under the head profits and gains of business. So if you look at the slide which is before you, this slide is giving you each section and the nature of deduction which is available. For example, section 30, it says that any rent, rates, taxes, repairs, and insurance premium which is paid for building of in which the business is presently operating from, any amount paid is allowed as a deduction. That is section 30. Section 31 says that similarly, if you are paying any repairs, insurance for machinery, plant, furniture, that amount is allowed as a deduction under section 31. 32 gives deduction for depreciation because depreciation is on the fixed assets which you own, and depreciation is calculated at the rates prescribed under the Income Tax Act. 32A is the deduction for investment allowances, and the further sections of 32AC is the deduction when you invest in new plant and machinery. 35AC is expenditure on new projects. 35 AD is deduction in respect of specified businesses. I'm not getting into these individual deductions because these deductions are relatively or fairly straightforward. When you read the section, that section itself will bring out as to what the deduction available to the assessee is, and that hardly needs any explanation. So considering that we have limited time, I thought of devoting time to some sections which need explanation or which need some discussion considering the complexity of those sections. And that's why these specific deductions, I have simply listed down the sections, and you can always refer to the Act for getting information as to what are these specific deductions. I'm not getting into detailed discussion of these deductions. What I felt important was section 37, which is a general deduction. So up till now, what we were looking at was section 30 to 36, which are specific deduction for each and every expense. But now you will understand, or you will agree, that it is not possible to list down each and every deduction which a business is entitled to, because every business would have different circumstances, different nature of business, and therefore it is not possible to anticipate what types of deduction every business may incur and provide for those deductions in advance in the section. And that's why the section has, the act has now provided for a general deduction section. It says that any expenditure which is not provided specifically in section 30 to 36, but which is not of capital in nature, because obviously if the expenditure is capital in nature, it does not qualify for deduction. You may get depreciation on that if such capital expenditure brings into existence some asset. So the expenditure which is not of capital in nature and which is not personal in nature, because personal expenditures are not allowed as deduction, but the expenditure, if incurred wholly and exclusively for the purpose of business, then it is allowed as a deduction for the purpose of calculating business income. So the conditions are threefold: that the expenditure should not be of capital nature, it should not be of personal nature, and it should be wholly and exclusively incurred for the purpose of carrying on business. If these conditions are fulfilled, under section 37, the amount is allowed as a deduction. Later on, a proviso or an explanation was added to the section, which says that if any expenditure is incurred for any purpose which is an offense, or any expenditure is incurred which is prohibited under any law, then deduction for such expenditure will not be allowed. So any expenditure obviously which is not legally incurred, which is something which any law does not allow, then even under Income Tax Act, deduction for such expenditure is not allowed. The section further says, there is an explanation too, which says that if any company has incurred any expenditure under the CSR requirements as per section 135 of the Companies Act, you all are aware that companies with moderate size, turnover, etc., under section 135 of the Companies Act, they are required to spend certain percentage of their profit on corporate social responsibility object. So if any company has incurred any expense out of the CSR regulations which are mandated under Companies Act, then such expenditure is not deductible under section 37. So though this expenditure you could say is incurred wholly and exclusively for the purpose of running of my business, but no deduction for such expenditure will be allowed under section 37. But there are several judicial decisions which say that such expenditures, of course, do not qualify for deduction under section 37, but such expenditure can qualify for deduction under section 80G. So if the donee is registered under 80G, and if 80G requirements are fulfilled, then the donor can claim 80G deduction for such CSR expenditure, but deduction under section 37 will not be allowed. And therefore, while doing the computation of income, if you see any CSR expenditure as part of the profit and loss account of the company, then that expenditure needs to be added back while doing the taxable income computation, because that amount is not allowed as a deduction. Now there is explanation 3, which defines as to what is the expenditure incurred by an assessee for the purpose which is an offense, or what is the expenditure which is prohibited by law. And the section goes on to say that if there is any expenditure which is incurred to provide any benefit or perquisite to any person, and acceptance of such benefit or perquisite by the person is in violation any law. That means that the company or the person expending is giving some benefit to the person who is receiving such benefit, but such receiving of the benefit is in violation of any law, then the expenditure incurred is an expenditure which is prohibited by law, and therefore the person expending such expenditure will not get deduction for such expenditure. Similarly, any expenditure which is incurred to compound any offenses, that means there has been violation of law and now you are required to pay a penalty to get the infraction of law compounded, and that amount which is paid for compounding of offense is also not allowed as a deduction under section 37. The section has a subsection 2b which says that any expenditure which is incurred by assessee on advertisement in any souvenir, pamphlet or any publication which is brought out by a political party is also not allowed as a deduction. So section 37 on one hand gives deduction for all expenses which are incurred for the purpose of business, but at the same time it has some restrictions which are given in explanation 1, 2 or 3 as to what are the expenditures which will not be permitted as a deduction under this section. So that was section 37. Now let's go to section 43b. This section allows a deduction for certain expenses only on payment basis, irrespective of the method of accounting followed by the assessee. Which means, take a case where you are following mercantile system of accounting. So under mercantile system of accounting, whenever any expenditure becomes due, or when the person carrying on business is liable to pay a certain expenditure, that expenditure is debited to profit and loss account, but it may not be paid at the same moment, but it could be paid at a later stage. So expenditure therefore is debited to profit and loss account based on the mercantile system of accounting followed by the assessee. So section 43b gives lists of items which say that expenditure for those certain items will be allowed only on payment basis. So irrespective of the year in which you have recorded that as an expenditure, deduction will be allowed only when you pay those expenses. And which are those expenses? First one, any sum payable by way of tax, duty, cess, by whatever name called, is allowed only when you pay it. Next, any sum payable by the assessee as an employer by way of contribution to provident fund or superannuation fund is allowed as a deduction only when paid. C, any sum referred to in 36(1)(2), that is bonus payable to employee. Next, any sum payable by an assessee as interest on any loan or borrowing, which is money borrowed from public financial institutions, state financial corporation, etc. So if there is any borrowing and interest is payable, then deduction will be available only when you actually pay that interest. Next item is any sum payable by the assessee on any borrowing which is a deposit taken from non-banking financial companies. So from NBFC, if you have borrowed money, any interest payable will be allowed only when it is paid. Next is any interest payable for loan taken from a scheduled bank is also not available as a deduction if not actually paid. Next is any sum payable in lieu of the leave. That means leave encashment paid to an employee will be allowed as a deduction only if the leave encashment is actually paid out to the employee. And the last item, before that, any sum payable or to the Indian Railways for the railway asset, or the last item which has been brought in by Finance Act 23, which will be applicable from 1st April 24. And that says that any sum which is payable by the assessee to a micro or small enterprise beyond the time limit specified in section 15 of the Micro, Small and Medium Enterprise Development Act. So that means if the business or if the assessee has purchased any commodity or availed services from an entity which is a micro or small entity as per the MSME Act, then if payment is not made to that seller or payment is not made to the service provider who is a micro or small enterprise, then the payment to be made to that person will not be allowed as a deduction. So now what is the period during which the payment is to be made to this MSME organization? The Act says that if payment is made beyond the limit specified in section 15 of the Micro, Small and Medium Act. Now, if you go and look at section 15 of this MSME Act, it says that when there is any transaction between a micro and small enterprise and any other person, then the payment has to be made between or within the time which is agreed between the two parties. So if there is a credit period given of 15 days, then the payment has to be made within 50 days to that person. If it is not paid, the amount which is payable will be disallowed. Now, the MSME Act further says that the amount or the period agreed between the two parties in no case exceed 45 days. So maximum period up to which the payment could not be made is 45 days. But if there is an agreement between two parties already, which decides the number of days, say 20 days, 25 days, etc., then payment has to be made within that time because that is the agreement between two parties for making the payment. Now, all these items or all these expenditures which are listed in this section 43B refer to that these items will be allowed as a deduction on payment basis. But there is a proviso to that section, and that proviso says that nothing in this section will apply. That means there will be no disallowance if the amount which is payable is paid before the due date of filing of the return. So if the return has to be filed by a particular date which is mentioned under section 139(1), and if the payment is made before the due date of filing of the return, then the amount which is debited to profit and loss account will be allowed as a deduction within the same year. But if that does not happen, then deduction for these expenses will be allowed as in the subsequent year when the amount is actually paid. So what is important here for the purpose of claiming deduction is the year in which the amount is actually paid by the person. Now, this section applies to, or this concession applies to all expenses other than the last entry, which we saw, which was about the latest amendment, which is brought in by Finance Act 23, which refers to the payments made to micro and small enterprise beyond the due date. So in this case, there is no time limit, etc., which is available up to the due date of filing of the return. If you make the payment beyond the time limit specified under MSME Act, the amount gets disallowed. That's it. Then in whichever year you may pay, you will not get deduction for the same because the Act does not provide for such concession. So that was peculiar section 43B. Okay, then let's come to section 41. Now 41 talks about the specific incomes which are chargeable to tax as business income. Now section 41 says that where there is any allowance or deduction which has been made in any assessment, prior assessment years, and then during the year, the amount for which deduction was claimed is received by the assessee, or you had written off the amount in past year as your loss or trading liability, etc., and then during the year you receive part of that amount, then that amount will be chargeable to tax under section 41 because the business has already enjoyed deduction for the same in the earlier years. So it's all fair that earlier year when you wrote off the amount or when you thought that there is a huge loss because of fire and my goods are destroyed, so the entire stock which was lying in a particular room is damaged and you have written that off, you are allowed as a deduction. But if subsequently you found that some part of that stock could be sold either as scrap or as a defective material, and by doing so you have got some money back, then that amount which you receive will be chargeable to tax as business income because you have already got deduction for such amount under the relevant section in the particular years. So 41 talks about what will be chargeable to tax when you receive some amount during the course of carrying on of business. Now there are, I think we have in PPT, I have missed out about section 40 because section 40 is the section which says that there are certain amounts for which deduction is not available. So these are the amounts. Section 40A1 talks about the payments which are made to any non-resident without deduction of tax at source. So on such payments which are made where there is no tax deducted or taxes deducted but not paid into government treasury, such amounts will not be allowed as a deduction. 40A1A refers to the same provision but where the payment is made to a resident. In such case, the deduction which is allowable is only 70%. That means if you were to pay 100 rupees to somebody, some resident, but on which you did not deduct tax, then 30% of that 100 rupees which you are supposed to pay gets disallowed. So during the year where you have not deducted tax and you were required to deduct, 30% will get disallowed, and in subsequent year when you actually go and pay the tax, then in that year the disallowance will get reversed and the amount which is disallowed in earlier years will be allowed as a deduction in the year in which tax is paid. So 40A1 talks about payments to non-resident, 40A1A talks about payments to resident. Then 48(2) says that any amount which is paid by way of tax, any surcharge, any tax on profit will not be allowed as a deduction. And there was a debate for long which says that if there is surcharge payable or cess payable on the tax amount, then will that also get covered by section 48(2), and there would be no deduction for such surcharge and cess paid. Thus, the definition given in section 48(2) clearly covers surcharge, and therefore there was no doubt on that. But whether cess of 4% which is paid, will that be covered within the definition of tax, and even the cess paid will be disallowed? There were decisions for and against. Based on the decisions which were in favor of the assessees were claiming the deduction for the amount of cess which is paid. But later on, there is a decision by Supreme Court putting a full stop to this and said that no, the amount of cess paid is also covered within the definition of tax, and therefore there will be no deduction available for the amount of tax, surcharge, and cess which is paid. There is another section, section 40B, which refers to the amount which is paid by the partnership firm to the partner. Mind well, this section says that any amount by whatever name called, which is paid by the partnership firm to the partner, can be allowed as a deduction as remuneration only if the partner is a working partner. So to a sleeping partner or a financing partner, as popularly understood, any salary paid is not allowed as a deduction. So it has to be a working partner. The amount of salary payable to him should be documented by way of the deed. It should be specified in the deed. Only and only then the amount would be allowed as salary or remuneration payable to the person. Of course, if it is within the range, that means how much profit one can distribute by way of salary, remuneration, commission. It is at 90% of the profit for first 1,50,000 profit, and for the profit beyond that, 60% of the profit is allowed to be distributed. So if the amount paid are within these limits and it is paid to a working partner, documented in the partnership deed, it will be allowed as a deduction. So this is about section 40, which lays down certain restrictions on payments which cannot be claimed as a deduction. With that, now let's come to a separate code by itself, which is presumptive taxation. Now you all know presumptive taxation scheme is the scheme which was introduced to give relief to small taxpayers and give them some comfort or give them some concession from maintaining the books of accounts. Logic behind that these are small taxpayers, do not have that machinery of maintaining books of accounts, bills, vouchers, etc. So the act says that if you are willing to disclose profit at a particular rate of your gross receipts, then you can be covered by presumptive tax and you need not maintain books of accounts. Now, which are the businesses which are covered? 44 AD has provisions for computing profits and gains of any business, not profession, business which is carrying on presumptive basis. 44 ADA has provisions for computing profits from profession on presumptive basis. 44AE is for calculating profits of a business which is engaged in implying, hiring and leasing of goods or carriages. So the scheme of all the presumptive taxation sections is the same. It says that in each section there is specific condition laid down. Say for example, in 44AD, which is the business of doing anything apart from the specific businesses which are listed here. So the business should not have a turnover exceeding 2 crore of rupees, or the business should not have turnover exceeding 3 crore of rupees if the cash receipts are less than 5%. So you are in the business of either trading or doing any other business activity, and the turnover does not exceed 2 crore or 3 crores, or under 44ADA, you are in the specified profession and your turnover or gross receipts do not exceed 50 lakhs, or they do not exceed 75 lakh if cash receipts are less than 5%. That means more than 95% receipts are by check. Then you can take benefit of 44ADA. 44AE says that this is the provision where the person is engaged in the business of leasing, plying, hiring of goods. And in that section, if you do not have more than 10 vehicles and you are offering income of rupees 1,000 per vehicle every month, per ton of gross vehicle every month, or at the rate of 7,500 every month, then such persons can go under presumptive tax scheme. Once you are in the presumptive tax scheme, you are not required to maintain any books of accounts. You have to offer income at the rates which are prescribed in individual sections. For example, the rate which is prescribed for section 44AD, that is any business, is 8% of gross turnover or 6% of the turnover, where the amounts are received by way of account pay check, account pay bank draft, or NEFT RTGS. So in short, where the monies are received which can be tracked, then one would declare only 6% as his profit. Otherwise, 8% profit is an acceptable profit. 44ADA, which is for professionals, the income which they can offer to tax will be 50% of their gross receipts under 44ADA. And under 44AE, as I was mentioning to you, the income per vehicle will be 1,000 or 7,500 for every month or part of the month. So in such circumstances, the people who are wanting to avail can declare this income, do not maintain bills, vouchers, books of accounts, etc., and continue paying the tax. But if one says that no, my profits are less than the limits which are prescribed under the section, then that assessee is required to maintain the books of account, get the accounts audited to justify the claim of less profit, and then a return can be filed based on the audit conducted. So two options: declare the profit as given in the act, or declare lower profit subject to the accounts being audited by a chartered accountant. The assessees who are claiming these presumptive taxation, any capital asset used in this business, depreciation is already deemed to be allowed to you, so that when you stop claiming presumptive, the written down value of the asset would go down as if depreciation was claimed in the respective year. So depreciation is deemed to be allowed. all expenses deduction for that is deemed to be allowed, except the deduction for any salary, interest, remuneration payable to the partner of a partnership firm, because deduction for this is separately allowed than the standard profit. That means if you are under 44 ADA and you are saying 50% of my gross receipts are taxable, then all the expenditures which you would want to claim are deemed to be allowed, and your profit, taxable profit, is 50%. So the assessees claiming this deduction have to file ITR 4 Sugam to claim benefit of 44 AD, ADA, AE, etc. Now, any person who opts for this presumptive tax and then in 1 year decides to opt out of this presumptive tax, then for next 5 years, he will not again be allowed to claim the benefit of presumptive tax. That means he'll have to wait for 5 years to once again claim the benefit of presumptive taxation. There is less time. Let's go to 44AA, which is maintenance of books of accounts. Now, Section 44AA of the Income Tax Act and Rule 6F of the Income Tax Rule deal with different provisions which are about maintenance of books of accounts. And the section says that every person which is carrying on any of the following profession is required to maintain the books if the gross receipts exceed 2.5 lakh. The professions are legal, medical, architecture, engineering, accountancy, technical consultancy, etc. So all these people have to maintain books if their gross receipts exceed 2.5 lakhs. Now, any person which is engaged in any profession other than the above listed professions is also required to maintain the books of accounts if the income from business or profession exceeds 2.5 lakh or the gross receipt exceed 25 lakhs in any of the 3 years immediately preceding the period. So in any of the 3 years you have exceeded 25 lakhs, then you have to maintain your books of accounts. Those people who are filing the return under presumptive scheme, but who are claiming the profit to be less than the profit provided under the respective sections is required to maintain the books of accounts and get the same audited as well. Now, if you look at Rule 6F, this rule gives the list of books of accounts which are required to be maintained: cash book, journal, ledger, carbon copies of bills, original bills. All these are required to be maintained. These books are required to be maintained and kept at principal place of business. And any failure to maintain these books of accounts will attract a penalty of 25,000. So one has to be really careful in complying the provision. Now, what are the provisions regarding the audit of accounts? Section 44AB says that any person carrying on business, if his turnover exceeds 1 crore, is required to get the accounts audited by a chartered accountant. This limit is increased to 10 crore when the cash receipts and payments do not exceed 5%. Person carrying on profession is required to get accounts audited if his receipt exceeds 50 lakhs. Any person claiming benefit of presumptive scheme and he claims that the profits are lower than the prescribed limit are required to get the accounts audited. Now, this audit report will be in Form 3CA, 3CB and Form 3CD. This 3CD is to be electronically uploaded by the chartered accountant with the income tax department. Then the taxpayer has to approve the report from his account, and this tax audit report is to be filed 1 month before the due date of filing of the return of income. If provisions of 44AB are not followed, then there is a penalty of 1,50,000 or 0.5% of total sales turnover, whichever is lower. Then there are certain points which one should remember while filing ITR form. I'm just running through it because we are short of time. Write your correct address, email ID, contact number, because the income tax notices or SMSs are received on email IDs or the phone numbers, and one needs to be careful to reply to those notices. Before filing the return, download your AIS, TIS statements and reconcile that with the accounts or the income which you are offering, because if there is any discrepancy there, please file replies and get the data in AIS and TIS rectified, because if the data of AIS, TIS and the return throws up any mismatch, we have found as a practical experience, CPC throws up an error while processing and gives proposed adjustment for not disclosing the income as per AIS, TIS. Any ICDS adjustments which are shown in tax audit report should be correctly filled up in the ITR form. Details of brought forward losses should be correctly shown with the due date, with the date of filing of the return, because if you write the date wrong and the date goes beyond the due date of filing of the return, then the loss will not be allowed to be set off, and therefore be careful while filing the return, writing the dates. All audit reports which are obtained, like the tax audit, transfer pricing, report for claiming deduction under various sections, should be correctly filled in the ITR form, showing the name of the auditor, the date of the report, etc. Foreign income, if you have the income and the tax paid outside India, should be correctly shown, because non-disclosure of foreign income also attracts provisions of Black Money Act. Therefore, be careful if there is a foreign bank account, any shares held in foreign currency, foreign companies, please show them correctly in the ITR form at the specific schedules which are there. If you're holding any shares in unlisted companies or any director's position, even those details have to be correctly filled up. Tax payment challan details, the serial number, the date should be correctly filled, because any mismatch will result in denial of credit of the TDS or of advance tax, SA tax, which is paid. And the return is to be filed with electronic signature if it's applicable, because you have tax audit, or without digital signature. With this, we have concluded the topic which was allotted to me for the day. Thank you all for this session, and thank you ICAI for giving me this opportunity to present this topic in front of all of you. Thank you very much.
So I think we can take the questions.
Yeah. Any questions?
I think no questions.
Okay.
So I would like to propose vote of thanks for the session. I sincerely thank CA Preeti Savla ma'am, Chairperson, Women and Young Members Excellence Committee, CA Abhay Hajar sir, Vice Chairman, Women and Young Members Excellence Committee in absentia, both of them, CA Sonali Godbole, Speaker of the session, and everyone associated with this program to make it a big success. Thank you.
Thank you.
Now I think we can start with our next session, which will be headed by our speaker, Toral Shah. I would like to introduce her. Toral Shah is a partner in the firm GBCA and Associates LLP for more than 21 years. Toral Shah specializes in transaction and business structuring, direct tax advisory and representations. She has been instrumental in setting up the transfer pricing practice of the firm and currently heads the estate and succession planning area of practice. She has assisted several promoters of listed companies in their succession planning through formation of private trusts, partition of HUS, and preparation of wills. She is a regular contributor to professional journals and member of the Journal Committee of the Chamber of Tax Consultants. We welcome you, ma'am.
Thank you, Suchita, for the kind introduction. Am I audible?
Yeah.
Okay, I'll share my PPT. So I thank the Women and Young Members Empowerment Committee for giving me this opportunity to share my thoughts on some of the text topics with all the members. So my coverage for today's discussion is clubbing of income, set off and carry forward of losses, deductions under Chapter 6 and exemptions under Section 10. I'm going to take up set off and carry forward of losses first, then clubbing, and thereafter the other two topics. So what is set off of losses? The process of aggregating items of income and items of losses. So in a given year, a person may have income from different sources. Somewhere he could have made losses and he could have made profits. Set off, we mean the totaling of all of that. Now, how much is allowed to be totaled up and how much is not allowed to be totaled up will be seen in the next slides. So here I will be, I've given the way I will be addressing the different heads of income. So that in the further slides, I will just write the short form: salary, IFHP, PGBP, CG, and IFRS for the separate heads of income. So one is set off within the same head of same year. Second is carry forward. So what is carry forward? By carry forward, we mean that after totaling up everything, you still end up with loss in some heads of income or in totality in certain head. That loss is allowed to be carried forward so that you can claim it as a set off in the subsequent year, depending of course on the income position in the subsequent year. So in India, we don't have a system of carry backward of losses, which some countries have. So carry backward would have been that if I had made profits in the earlier year and then I had loss in the next year, I could have claimed some set off and claimed some refund. But in India, we only have a system of carry forward. So loss incurred in year one can be set off in the subsequent years, depending on the head under which you have made the loss, the years to which the loss relates. So the hierarchy of the section is like this. Intra-head set off. So within the same head of income, the losses are set off. Say for example, if a person is carrying on 3 types of businesses, he's trading in plastic materials, he's trading in some steel materials, and in each head he makes a separate profit and loss account, and he ends up making loss in say steel business and has profit in the plastic business. Within the same head of income, both the businesses incomes will be clubbed. So the negative income and the positive income will be set off against each other, and depending on whether the loss was more or less, his business income will be computed. That is intra-head of income, which is covered under section 70. Inter-head set off is after the business head in our example is computed and the net effect is say a loss of 20 rupees. So he had 100 rupees loss in plastic business, 80 rupees loss in his pipes business. The net effect under the head after intra-head set-off is a loss of 20 rupees, that is eligible for set-off against other heads of income, which is section 71. Then there are other sections which talks of specific heads of set-off for house property, for business income, for race horses, etc. And then there are certain scenarios like amalgamation, succession, etc., for which there are specific sections. This is the scope of our coverage for today, so far as this topic is concerned. So section 70, loss from one source can be set off against income from another source under the same head. Now there is one exception to this rule. So far as long-term capital loss is concerned, although you have the head capital gain, it cannot be set off against any capital gain except a long-term capital gain. Short-term capital loss can be set off against long-term capital gain or a short-term capital gain. However, if it is a long-term capital loss, it can only be set off against long-term capital gain. This is one exception to intra-head set-off of losses. Now, what does section 70 say? Save as otherwise provided in this act, where the net result of an assessment year in respect of any source falling under any head of income other than capital gains is a loss, the assessee shall be entitled. Now, this word is important, shall be entitled to have the amount of such loss set off against his income from any other source under the same head. So the only exception here is capital gains. The next two subsections talk of what happens in the two scenarios. There are two different capital gains. One is short term and the other is long term. So subsection 2 says that short term loss can be set off against similar loss from any other capital asset. So that means a short term loss or a long term loss. However, when you read subsection 3, it says that long-term loss can be set off against similar loss, which is not a short-term capital asset. So that means a long-term capital loss can only be set off against loss from a long-term capital asset. Now the question is whether you have a choice to set off intra-head, or you have a choice to say, okay, I don't want to set off my loss of business 1 against the loss of business 2. I will carry forward my business 1 ka loss to the next year. I don't mind paying taxes. Now, if you read section 71, the language seems to say that there is no such choice or option available to the assessee. It starts with the net result of compare the net result of the computation under any head of income. That means first you have to do a net effect at the each head of income level. Only then you move to the inter-head set-off of losses. Similarly, when 71B talks of, when it talks of carried forwards of losses, it talks of the net result of computation under any head of income. So reading these sections, we come to a conclusion, or we may deduce that intra-head within the same head of income, you don't have a choice. You have to set it off. Only then you move to the inter-head set-off of losses. Now, what could be the rationale why long-term capital gain loss is not allowed to be set off against short-term capital loss, capital gain rather? Because as it appears, long-term capital gain is taxed at 20% and 10% in certain cases. However, short-term capital gain is taxed at normally a slab rate unless it is equity share is listed where it is 15%. So here someone could take advantage that if he has a long-term capital loss, he could book capital gain and try to claim a set-off. That could be one rationale for not allowing the set-off against the same head of income between capital gains. Now there is a question could arise that loss from non-taxable source, whether it is available as a set-off. Say, for example, in the regime when dividend was exempt in the hands of the shareholder, and if somebody had borrowed money and invested shares and he would show a loss because of the interest expense, would the negative exempt loss be allowed as a set-off? So there are case laws which say that exempt income per se doesn't enter the computation mechanism. So no set-off should be allowed. There is a contrary Mumbai ITAT decision which says that if the source of income has two types of incomes, one is tax as well as non-taxable. In that case, the court had given a view that you could claim the set-off of the exempt income also against the taxable income. But now that most of the incomes are taxable, I don't know how relevant this case law is, but there are differing views on this issue. But normally we would believe that exempt income will not enter the computation mechanism, and so no set-off will be available if there is a loss in an exempt source. Now, what about clubbing of income? So as we will see ahead, and as we are all already knowing, that income of minor children, income of spouse in certain circumstances is clubbed in the hands of the parent or in the hands of the other spouse. Now, what if in clubbing, the spouse has actually made a loss or the minor child has made a loss? So would the minor child's loss also be available to the person in whose income, in whose hands the income is getting clubbed? So we have the Supreme Court decision in the case of Kotla, where the Supreme Court has said that in clubbing, you have to club both incomes, positive as well as negative. And if there is a negative income, say of a minor child who has made a capital loss, for example, when the income is clubbed in the hands of the father or the mother, the loss will be allowed to the father as for set off, of course, in accordance with the provisions of the sections. So loss from one head is set off against income of another head is allowed, and there are some exceptions to this rule. Now we have come to section 71. In 70, we said income from the same head is to be set off. Now, after doing that, also I end up with loss in some heads of income. Then I'm allowed to set off income from, say, a business, of business, PGBP, or income from house property against other heads of income. Now, there are certain exceptions to this basic rule. One is speculation loss. So, if I have loss in speculation business, say speculation is where the transaction is done without delivery of goods. Say in case of shares, I do an intraday trading of shares and end up with a speculation loss. In that case, I will not be allowed the set-off of the loss unless I also have speculation income. So a speculation loss is only available against a speculation income. Similarly, losses relating to capital assets, which we have already seen, capital gain loss can only be set off against capital gain, and also there are other rules about LTCG only against LTCG. Then losses in relation to specified business under section 35AD. So 35AD is allowing some special deduction to certain businesses, say for laying down gas pipeline, for starting a hotel. They have specified certain businesses who will be allowed the deduction, special deduction under 35AD. So if this loss is arising on account of a specified business which are listed in 35AD, then this loss will only be allowed as a set-off against another specified business which is listed in 35AD. It will not be allowed for set-off against any other heads of income. Losses under the head income from other sources, also again an exception, which we'll see further. Then loss from PGBP is not eligible for set-off against salary income. So if you have a salary income and you are doing some business and you have a loss in the business, if this is the only two source of income, then your loss in business will not be allowed to be set off against your salary income. You will be allowed to carry it forward, but not set off. Loss from house property, you can set it off against another head of income, but only up to a cap of rupees 2 lakhs. Balance you can carry forward. So this is section 71 with the exceptions. So there is a case law which says that it is the AO's duty that even if the loss is not correctly claimed as set off, he has to allow the set off. I think now this does not remain relevant because now everything is so, our return forms have become so AI enabled. It will claim the correct set off. They are all linked, formulas are based. So I don't think that this will any longer remain a challenge, but in any case, the fact remains that it is the AO's duty that you should be given the set off as is appropriately you are entitled to, even if you have not claimed the set off of loss. Now, so we are going to each head of income. When in any assessment year, the SSE has a loss and such loss cannot be set off wholly against income of any other head. the same shall be carried forward to the next assessment year, subject to fulfillment of certain conditions. We saw interhead, we saw intrahead. Now I am not able to set off. Now I am going to the carry forward. I am going to carry forward the losses that I have income. So when it comes to house property income, after both intrahead and interhead also, I am ending up with a loss. The loss, I am eligible to carry it forward for the next 8 assessment years. And I can set it off only against income under the head income from house property. So this is the condition. I can carry it forward for the next 8 assessment years for set off only against IFHP. So here in the same year, I am only entitled to set off 2 lakhs. See, if I had loss of 5 lakhs in income from house property, 2 lakhs I am entitled to set off against other heads of income in the same year. Balance 3 years, 3 lakhs, I can carry it forward for set off in the subsequent years for a period up to 8 assessment years. Now carry forward and set off for business losses. Again, loss in PGBP, I am allowed to carry forward for the 8 assessment years. And again, it can only be set off against the head profit and gains from business and profession. So now we will go through the extract of the section and we'll appreciate what it means in the next slides. Where for any assessment year, the net result of the computation in the head PGBP be carried forward to the following assessment year. It shall be set off against the profits and gains, if any, of any business or profession. Here, any is important. Carried on by him and accessible for that assessment year. If the loss cannot be wholly so set off, the amount of loss not so set off shall be carried forward to the following assessment year and so on. So now, what do we try to deduce from this? Some controversies which have come up earlier in this connection. Sorry. So in case of dividend income, while dividend falls under IFOS, there have been earlier disputes whether business loss can be set off against dividend income. If I am in the business of trading in shares and securities and I am earning this dividend which is incidental to shares and securities, we have the Supreme Court decision in case of Kokanada Radhaswamy, which has said that yes, because the dividend has come because you were trading in shares and securities, it is in the nature of business income and you can claim set off of your other business loss against the dividend income. The next question is, same or different business? Is it necessary that in year 1, if I was doing business of say pipes, in the year 2, my business is of say trading in some other material? Can I be allowed the loss of pipes business in the next year against my business of the other product? Here, the word used as we saw in the earlier slide was any business or profession carried on and accessible for that assessment year. So here, it is not necessary that you need to carry on the same business. The loss can be set off against any other business that you may carry on in the subsequent years. The next question is, do I need to also carry on the business in which the loss was incurred? So prior to 1999, the requirement was that the SSC should have continued the business in which loss was incurred. However, now there is no such requirement. Even if the business in which I had incurred the loss is no longer continued, I am entitled to set off the loss against other businesses that I may do in the subsequent years. Now, carry forward of business loss and unabsorbed depreciation in case of reorganization. Now, we will look at situations where losses are there and there are actions like amalgamation, demerger, or a firm is converted into a private limited company, a proprietary concern is converted into private limited company, and so on. So, while an SSE who has incurred the loss is in the normal circumstance allowed to carry forward that loss and also set it off against his income in the subsequent years, no other person can claim the set off. However, there are some exceptions to that rule, and we will see those exceptions. The first scenario is amalgamation. So when company A gets amalgamated into company B, and company A had incurred losses, which it is still eligible, say only 3 years have been completed, and it still has 5 years to go when it can claim the losses against its future incomes. However, before that, the company A in its 4th year is getting amalgamated into company B. Now, what happens to the losses of this company A? So there are rules which have been prescribed. If the rules are satisfied, then the loss is eligible. Now let us come to the rules that are prescribed. So far as company A, that is the amalgamating company, is concerned, the rule is that it should have been in the same business for at least 3 years before. Continued 3 years, it should have been in the same business to which the loss relates. And 75% of its fixed assets that it holds at the time of amalgamation, it should have held at least 2 years prior to the date of amalgamation. These are the two conditions that company A, that is the amalgamating company, needs to fulfill. Now, coming to the company into which it has amalgamated, that is company B. What are the conditions that company B needs to satisfy so that it can avail the set of laws that company A brings with it when it is getting amalgamated into company B? The condition is that the amalgamated company holds at least 75% of fixed assets acquired in amalgamation for at least 5 years from the date of amalgamation. And it continues the business for at least 5 years and fulfills such other conditions. So it has to fill up for Form 62 as per Rule 9C, and then it will be allowed to set off the losses. So there are two conditions for the amalgamating company and there are two conditions for the amalgamated company, so that the amalgamating company's losses can be set off by the amalgamated company against its business income. Now coming to the second corporate restructuring scenario, which is demerger. Now, in case of what is demerger, when a company is split or undertaking is demerged, say a company which is in the business of petrochemicals and there is also a finance wing that it has, it demerges its finance department or a finance business, which is called demerger, and then you end up with two separate companies, a demerged company and a demerging company, or a resulting company and the demerged company. So now that when these two units within a single company, there are two separate businesses which are getting carried on. What happens to the losses? The company has losses from both the businesses separately identifiable, and there can be losses which are not directly relatable to a certain line of business. What happens in that case? What happens to the losses? So where the loss is directly relatable to a certain segment, say for example, when the petrochemical business continues in the same company and the finance business is demerged, and the finance business had been incurring losses since the last 2 years, those losses will get tagged along to the finance active business and it will go to the demerged entity. Now, what happens if there is loss which is not directly relatable, or that is a hodgepodge? Then, in case of demerger, in proportion to the assets transferred, so say the net worth of the company as a whole was say 100 crores. When it demerges, the net worth of petrochemicals is say 90 crores and the finance arm is say 10 crores. The losses will also get demerged. Losses will also get demerged in the same proportion. So the demerging company will get 10% of the losses and the continuing petrochemical company will get 90% of the losses. Losses which are not directly relatable. First, you look at what are the directly relatable losses, and that tags along with the concerned business. And those losses which are not directly relatable, you have to apportion them in the proportion of the assets transferred. Another scenario is conversion of a firm into a company. So when you do a conversion which is compliant with 4713, which prescribes the condition when such a conversion will be tax neutral. In that case, the firm which had incurred the losses, when it gets converted into a company and it satisfies the conditions prescribed under the section 4713, then in that case, the loss of that firm will become loss of the company and it will be allowed to be carried forward. Now, looking to the section, the way it is worded, if I may read it out. So, now the question remains is that, say, for example, the firm had incurred the loss in 2014. In 2017, it gets converted into a company. So already 3 years have passed and the loss is 3 years old. Balance losses remaining. Period remaining to the firm is only 5 years if it were to continue as a firm itself. However, in 2018, it gets converted into a company. The question is whether the company will be eligible to carry it forward for 5 years or the loss gets a new lease of life and it will be carried forward for 8 years. Now, I'm just reading out from the section and there could be two views on the matter, but from an verbatim reading of the section which reads as under, where there has been a reorganization of business and a firm is succeeded by a company, etc., as the case may be, the accumulated loss and the unabsorbed depreciation of the predecessor firm or the proprietary concern, as the case may be, shall be deemed to be the loss or allowance for depreciation of the successor company for the purpose of previous year in which business organization was effected, and other provisions of this act relating to set off and carry forward of loss and allowance of depreciation shall apply accordingly. Now the word used is for the purpose of previous year. It will be deemed to be the loss or unabsorbed depreciation of the successor company for the purpose of previous year in which the business reorganization took place. So from a apparent reading of the section, a view could be formed that it gets a new lease of life, and from the year of succession of the firm by the company, from that year onwards, you have to start counting 8 years. I have not been able to lay hands on any case law on this topic, but yes, it would be interesting to know whether, and we can explore this possibility. Similarly, in case of conversion of a proprietary concern into a company under 4714, similar provisions apply. Again, this both conversions are covered under subsection 6 of section 72A. So the language is similar. Again, whether it is allowed for 8 years or it will be for the balance period could be a controversy. It is important that in both the scenarios, you have to fulfill all the conditions of 4713 and 14. Where, for example, in case of conversion of a proprietary concern into a company, all the assets of the concern have to become the assets of the company, and the proprietor has to get only shares in lieu of this conversion, etc., etc. If those conditions are satisfied, only then you are entitled to carry forward the loss, or else you are not. Similarly, in case of a firm, all the partners of the partnership firm have to become shareholders of the company. They have to continue to hold not less than 50% of the shares for a period of 5 years. So if at any point that after conversion, at any point of time, any of the conditions under 4713 or 4714 is not satisfied, in the year in which the condition is not satisfied, there will be a tax incidence. And the loss that is allowed to you in earlier years will be taxed in that year. Now, conversion of unlisted company into an LLP, again, same provisions, LLP, a private limited company which satisfies all the conditions for a tax neutral conversion, not having net worth more than 5 crores and all the shareholders become partners of the LLP, etc. If all those conditions are satisfied and you are a tax neutral conversion under 4713B, then losses of the unlisted company will be allowed for set off to the successor LLP, subject, however, to the condition that you satisfy the conditions which are prescribed even after the conversion under sections 4713B. Now coming to speculation losses. So what is speculation? As we already discussed, a contract settled otherwise than by actual delivery of commodity or scripts. Exception are hedging, jobbing, arbitrage transaction, and trading in derivatives, which are specifically considered as normal business activity, don't fall in the definition of speculation. So loss from one such business can be set off only against profits and gains of another speculation business. If you have speculation loss and you do not have speculation gain, or your speculation gain is not equivalent to your speculation loss, then the unabsorbed or unutilized speculation loss of 1 year can be carried forward, but here the period of carry forward is only 4 years. As we saw earlier in the normal other provisions, the period of carry forward was 8 years for the other heads of income. However, for speculation business loss, the period of carry forward is only 4 years. And in subsequent years also, the set-off is only allowed against speculation income. There is one case law which says that damages for breach of contract without delivery, not a speculative transaction. Now, this is based on facts of that case. We may not get into that. And commission, a brokerage received on a speculative transaction, again, is not speculation profit, again, based on some case law. Coming to section 73A. So section 73A talks of set-off of loss incurred in specified businesses. So examples of specified business under section 35 AD are if you have a cold storage plant, if you set up a cross-country natural gas pipeline, or a new hospital with at least 10 beds, 100 beds, etc. There is a list of businesses which are specified businesses under 35 AD. Now, if you are carrying on a business which is specified business under 35 AD, and you incur loss in that business, you can set off that loss only against another such specified business. So you cannot say you have a specified business of having set up natural gas pipeline. At the same time, you are also doing trading in some commodity. And you incur loss in this 35 AD. And you have availed of the 35 AD deduction benefit, of course. And you have availed that deduction and your loss is a 35 AD business loss. You cannot set off this loss against your other normal business loss income. You will be only allowed to set it off against another 35 AD business if you have, or you can carry it forward and set it off against your future income from such a specified business. Interesting part is here, there is no period prescribed. The loss can be carried forward indefinitely and set it off against any other future business of similar nature. So you have an open-ended period for set off. Now coming to the specific provision relating to capital loss. As we saw earlier, the loss, short-term capital loss can be set off against both short-term capital gain as well as long-term capital gain. Long-term capital loss can only be set off against long-term capital gain. Now question is, what is the loss what is the amount that has to be considered as the loss? Whether the gain before claiming the deductions under section 54, 54F, 54EC, etc., or after those deductions. So there was a controversy which had come to the Mumbai ITAT where the AO was alleging that you will not be allowed the deduction under 54. First, I will set off your brought forward losses. Say I have made a 1 crore profit in the current year as long-term capital gain. I have brought forward capital loss of say 75 lakhs. And I have also invested in a new house which I am eligible to claim deduction under 54. Now the AO's allegation was that, AO's contention was that my 1 crore profit in current year, first I should take the set off of the loss of 75 lakhs which I have incurred in the preceding year. Then whatever is left is the amount for which I am eligible for a deduction under 54. However, the ITAT has said, no, your computation of capital gain is complete when you have claimed the deductions which are allowed to you in that specific year. So, against the 1 crore income, if I have a 54F of say 75 lakhs, then first I have to claim that set off. So, I will be left with a residual capital gain of 25 lakhs. Only then the loss comes into picture. Then out of my preceding year's 75 lakhs loss, only 25 lakhs will be utilized in this year. Another 50 lakhs, I will be still eligible to carry it forward for a period of 8 years. Now, short-term capital gain on sale of depreciable asset. As we all know that section 50 says that if you have a capital asset on which depreciation is claimed, then the gain arising on that is to be considered a short-term capital gain. The controversy is whether, because my gain is becoming a short-term capital gain, does also my asset, which was otherwise held for a period of more than 3 years, or 2 years as the case may be, become a long-term capital, short-term capital asset. So we have Bombay and Delhi High Court both which have said that although if it was a gain, it would be taxable as short-term capital gain, but for the purposes of section 54 EC or for the purposes of set-off of losses, if you have held that asset for more than the period prescribed and it becomes a long-term capital asset, then you will be eligible for set-off of short-term capital loss against the long-term capital gain. So in short, the controversy is whether, although the gain becomes short-term capital gain if my depreciable asset is sold and I have a gain. However, my asset doesn't become a long-term capital asset. Sorry, it doesn't become a short-term capital asset. It could be a long-term capital asset if I am held it for the prescribed number of years. Now coming to section 74A, which talks of loss under the head income from other sources. 74A is talking of only one source of income which falls under IFOS, and that is loss from activity of owning and maintaining resources, which can be set off against income from the same activity only. So now, interestingly, this is the only topic of loss which is allowed as set off and carry forward. For carry forward rather, set off is allowed, of course. For carry forward, only they have spoken about loss from activity of owning and maintaining resources. So as a rejoinder, it means that no other loss that you may have incurred under the head IFOS is allowed for carry forward. Now coming back to the topic of owning and maintaining resources. So if a person has this business of owning and maintaining resources, and he or she has made a loss in that business, then the carry forward is allowed and the loss can be set off only against similar business of activity of owning and maintaining resources. One. Second, it can only be carried forward for a period of 4 years. There were case laws which said that what if the horses have never been made to run, or rather never participated in a race? Then whether the expenses or the losses that you incur for owning and maintaining those horses can be considered for set off. So there are decisions which say that it is not that you have to, the law doesn't say that the horses should have run a race. So long as they are race horses intended to participate in racing, you will be eligible to claim the loss as set off or carry it forward in the subsequent years. No other IFOS can be carried forward. So as we discussed earlier, except for this income, no other income or loss under the head IFOS can be carried forward for future set off. Now coming to scenarios where there is reconstitution in case of a partnership firm or change in the shareholding pattern in case of certain companies. So what happens if in a partnership firm there is a change in the constitution of the partnership? Now the change could be because someone retires or someone dies and there is a change in the partners. Now the law is that where there is a change in constitution of the partnership, the loss that is relatable to the share of the partner who has exited, maybe because of retirement or because of demise, will not be allowed as set off in future to the firm. So say, for example, you take a scenario, a partnership firm with Mr. A, B, C and D as partners having equal share. In year one, the partnership firm had made losses of say 10 lakhs. So the share of loss attributable to say Mr. A was 2,50,000. Now, after 2 years, Mr. A retires from the business for some reason. So when he retires in that year, from that year onwards, only 75% of the loss, so say 7,50,000, relating to the 3 continuing partners will be allowed as said, carry forward there from that year onwards. The 2,50,000 loss, which was relatable to the partner who left the firm, will no longer be allowed to be carried forward and set off in future to the partnership firm. Here, this is applicable to losses. When it comes to unabsorbed depreciation, you can continue to carry it forward, and the change in constitution does not affect this set off. And when there is a succession of a business, say for example, a proprietor was carrying on business, he made some losses. Because of his demise, his son is succeeding him in his business due to inheritance. In that case, the loss that was incurred by the proprietor will be allowed to his son because the succession has happened because of inheritance. Now, this loss would not have been allowed if the proprietor had, handed over his business during his lifetime to his son, and there were losses which were to be carried forward. That loss would not have been available to the son, but however, because the succession of the business happened because of inheritance or demise of the proprietor, the son will be eligible to carry forward and set off the losses which his father had incurred in the same business. Now, coming to companies. In case of a company, if there is a change in the shareholding pattern, so of course we are talking of a company in which the public are not substantially interested. That means not listed companies, but we are talking of private companies. If there is a change in shareholding pattern, then unless 51% of the voting power is held by the persons who held 51% of the voting power of the company on the last day of the year in which the loss was incurred, then only you will be then only the company will be eligible to carry forward the loss incurred in that year. There is an exception to this rule for startups. In startups, they are giving a benefit which will come to later. Now, first discussing the first part of it. Say a company, private limited company, had 10 shareholders. Each one was holding 10% of the share capital. Now, for some reason, out of that, 6 of the shareholders sold their shares to outside shareholders, not to the existing shareholders. So 60%, there is a 60% change in the shareholding of the company. So in year 1, on 31st March, there were 10 shareholders. And in year 3, say, after the sale of shares by the 6 shareholders, the number of shareholders are 10, but the 6 shareholders are different shareholders. Now, you will not be allowed the set off because not less than 51% of the voting power has changed hands. So more than 51% rather, voting power has changed hands. Interestingly, what the word used is not shareholding. The word used here is voting power. Now, if the shares held were carrying differential voting power, say each share that a person held was carrying, every 10 shares was carrying 1 voting power. So voting power of the existing shareholders was less, although their shares in numbers was equal all the 10 shareholders. Then you don't look at the number of shares that have changed hands. What you have to look is whether voting power continues to be with the same 51% of the shareholders. So not the number of shares, but it is the voting power that has to be focused on to determine whether the losses will be allowed to be carried forward for future set-off. In case of startups, the government, to encourage startups, has given a lenient provision. In case of startup, the percentage is not prescribed. However, what the government is saying that those people who were shareholders when the loss was incurred, in the year in which the loss was incurred, and they continue to be the shareholders in the year in which you are claiming the set-off of the loss, then the set-off is allowed. So it could be that there were 4 friends who started the new startup, and then they found some good investors, and all of them sold all their shares to the new investors, except one share each. That means, and the startups obviously make losses in the initial years. But because all the 4 shareholders are the shareholders in the year in which you are wanting to claim the set-off of the loss, you will be eligible. Here you do not have to look at the percentage of voting power that the old shareholders were holding. Now, there are some exceptions to which this voting power condition would not apply. Now, one is change in the voting power and shareholding takes place due to death of a shareholder or on account of gift. Say, for example, father dies, one of the shareholder dies and he gives his shares to his son. So, obviously, there is a change in the shareholding. But here you do not look at the realignment of the voting rights amidst the shareholders because this transfer has happened on account of death of a shareholder. Similarly, if the shares were given as gift to any relative, say the father had gifted the shares to the son, again you do not look at the shareholding change. You ignore rather the shareholding change because these two scenarios are an exception to the rule that 51% has to be with the same shareholders. Now, change in the shareholding of an Indian company, which is a subsidiary of a foreign company, as a result of reconstruction of a foreign company. Here you are allowed to claim the set-off, provided the conditions that you need to satisfy is that 51% of shareholders of the amalgamating or demerged foreign company continue to be shareholders of the amalgamated or the resulting foreign company. Also, a similar condition that 51% of the shareholding continues to be the same of the foreign company, although there is an action of amalgamation or demerger. And of course, in case of a resolution plan which is approved by the Insolvency and under the Insolvency and Bankruptcy Code 2016, and when there is a resolution plan which is approved by the tribunal under the Companies Act 2013, in these scenarios, you do not have to bother about the change in the shareholding pattern, and the loss that is incurred will be allowed for future set-off, irrespective of the shareholding or voting power held by the continuing shareholders. So, why they have put all these conditions? The rationale would be that there is no buying of losses. Now, it would have been very simple to sell your losses. So, if a company A had incurred losses, it could merge with a company B, and the loss will be available to the company B, and there could be some monetary advantage that the shareholders could derive. So, to avoid any such loss trading, this rationale of shareholding pattern is provided. Now, interestingly, one very finer point which could be an issue some point of time. Under the Companies Act, there is a section which says that if preference shares are not given dividend for 2 years, then they will end up having voting power equivalent to the equity shareholders. So unknowingly, the company's shareholding pattern may change merely because the preference shares have now come into the shoes of the equity shareholders so far as the voting power is concerned. Now, this section gives automatic power unless the MOA and AOA of the company provide that even if dividend is not given, they will not be entitled to similar voting power. So you have to be careful that your MOA AOA is providing for such conditions. Otherwise, if the preference shares holders are not given dividend within 2 years, automatically the shareholding pattern constitution of the company could change, and depending on how many preference shares have been issued, you may end up in a scenario where there is a more than 51% change in the shareholding pattern, voting rights of the company. So this section 79 set off and carry forward applies to those losses which are computed under the Income Tax Act normal provisions. It does not apply to MAT losses computed under 115JB. So there is a case law which says that holding by subsidiary is considered to be beneficially held by the holding company. So any change in that holding company structure should not affect the losses. However, there is also a Delhi High Court which is a contrary decision. So this could be based on facts of each case, but you need to be careful when you are doing any kind of change to the shareholding of the company when you want to avail the benefit of future set-off of the losses incurred. Now coming to losses and set-off against income which is identified or assessed when there is a search, requisition or survey. So when there is a survey action under any of these provisions and undisclosed income is added in the return of the assessee, no set off of loss or any unabsorbed depreciation is allowed against the income, or rather the undisclosed income which is included in the income of the SSE on assessment. So this is interesting. So if some undisclosed income is identified in search, in your assessment, the income is added in the assessment under 153A. Although you may have a lot of losses which are eligible for set off, so there is an undisclosed business income which is added, and you have brought forward business losses. However, because this is added as undisclosed business income, those few brought forward losses will not be allowed to be set off against the undisclosed income. One very important point that we need to be careful about is that in case of losses, it is very important that your return of income of the SSE goes within the time allowed under 139(1). Mind you, the section is 139(1) and it is not even a belated return. So you can revise your return provided you have originally filed your return under 139(1). So in all the cases where your SSEs are incurring losses, you have to ensure that the return definitely goes within the due date that is prescribed. So now, after the set off and carry forward of losses, are there any questions? I move to the next topic, income from other clubbing of income.
No, ma'am, everything is clear. So we do not have any questions.
Okay. So coming to the other topic that I'm supposed to cover, clubbing of income as we normally call it. So normally under law, I am obviously going to be taxed on income that I earn, but there are some exceptions to that rule or provision. And there are certain sections under which even income of some other person could be clubbed in my hands, or income that I have earned could be clubbed in the hands of some other person. Now let us see what are those scenarios. So these are the sections. Section 60 is transfer of income without transfer of assets. We will look at it in detail as we move forward. Then revocable transfer of assets, where I transfer the assets but reserve the right to call back the assets. Transfer irrevocable only for a specified period. Then also section 62 provides for clubbing. Income of individual will include income of his spouse or minor child, etc. in certain scenarios. Liability of person in respect of income included in the income of another person is section 65. So as we said, normally a person is always charged to income in respect of income that he earns. However, if a person alienates or dissociates himself from a particular asset doesn't dissociate himself from the asset, but only dissociates himself from the source of income. So he continues to hold the asset. The ownership he does not transfer, but he assigns the right to receive the income to any other person. Say hypothetically, I am a partner in an LLP. I have the right to assign the profits of another person profits of my share of profits in the LLP to another person. The LLP Act allows me to do that. So when I alienate, I don't give away my asset, which is my profit sharing right in the LLP, but I say that income from the LLP I will assign to X person. Then clubbing could come into picture because I have not alienated the asset, but only I have alienated the income from the asset. Or say, for example, I say that I am holding this house property and income from this house property will now belong only to a private family trust which I have formed. In that case, again, I have not alienated the asset, only the income is alienated. So in those scenarios, the income which accrues to that trust, for example, will get clubbed into the person who continues to hold the asset. So for transfer of dividend income without transfer of shares, assignment of interest in partnership, assignment of contract, or assignment of business conducting charges, etc. All these are examples where you don't transfer the asset, but you transfer the income from the asset. In that scenario, the person who receives the income will not be subject to tax, but the person who has given the right of the income to other person is the person in whose hands the income will be clubbed. So now the next scenario is where I transfer asset also, but it is not an irrevocable transfer. Now what is irrevocable and what is revocable? An irrevocable transfer is where I give away all my rights in the asset to another person. An unconditional permanent transfer of my right in an asset to another person. Say I form a private trust and I have shares in a listed company. I put all my shares of that listed company into the trust, and the trust is an irrevocable trust. In future, I can never call back those shares to myself. I can never say, okay, give me back the shares. That is an irrevocable transfer. However, if the trust that I have formed is a revocable trust, so in the trust, it will be said that this asset, this trust is going to be a revocable trust, and the settlor reserves the right to take back the asset. In that case, just a minute. Sorry. Yeah. So in the case that the settlor or the transferor says that I reserve the right to call back the asset to myself, then it is a revocable transfer. So in that case, although I have transferred the shares, in future the dividend continues to come to the trust. The capital gain on sale of that asset also continues to come to the trust. However, the income will continue to be taxed in the hands of the person who has transferred it to the trust. Because the transfer is not an irrevocable transfer, but it is a revocable transfer. So here we have explained, defined under section 63. So revocable transfer is defined under section 63, which contains a provision for retransfer directly or indirectly of income or asset, and gives the transferor a right to reassume power directly or indirectly over the income or the asset, both. Clause in the transfer document for reassuming power based on a contingent future event does not amount to right to reassume. Clubbing does not apply. So this is based on the facts of a case, that because it was contingent on a future event, that is why the transferor did not have unfettered right to receive back the property. So it was not a revocable transfer. So here again, there is a case law which says that I am a resident of India. I may have given a revocable transfer of asset to somebody outside India. That does not matter. So long as the transfer is revocable, the income will continue to be taxed in the hands of the transferor. Now, exception to section 61. So if I transfer asset to a trust, in our same example, the asset was transferred, but the revocable nature was only after the beneficiary for whom I had transferred the asset does not survive. So say, for example, I make a trust for the benefit of my father. I put certain assets into them, and I say that so long as my father is alive, I do not have a right to call back the assets. In that case, because it is not revocable during the lifetime of the beneficiary, it is not considered as revocable, and there will not be a clubbing of income. So benefit must be real. The benefit may be direct or indirect, must be real. Anything which is abstract, remote, or contingent cannot be called a benefit. This is based on a case law. So income of individual, coming to section 64, where you have to club the income of spouse, in the income of the SSC. So where, say for example, I am receiving salary from a partnership firm where my husband is, or any of my relatives are holding more than 20% interest in the concern. So they are more than 20%, having more than 20% share in the partnership firm. That partnership firm is giving me a salary. Now, if that salary is not attributable to my technical or professional qualifications, or some knowledge that I had and experience that I hold, then the income that I'm going to get is going to be clubbed in the hands of my spouse. Income from, so that is first provision. The other is where income from assets transferred directly or indirectly by the SSE for inadequate considerations to spouse or son's wife or any AOP or BOI for the benefit of the spouse or son's wife will be clubbed in the hands of the transferor. Say, for example, if husband is transferring, say, a property, a house property, to his wife for inadequate consideration. Say the property is worth 2 crores and he's giving it to his wife for 1 crore. Then whatever income that arises on that asset which is transferred to the spouse will be clubbed in the hands of the SSE. Similar is the condition when such a transfer is made to the son's wife or any AOP for the benefit of both either his own wife or the son's wife. So to avoid any transfer of income to any other female member. Now, I personally have a very strong feeling that why these clubbing provisions are against the women fraternity, that apart. So, but as we, that is the way the law is. Some representation should be made is what I always feel. But then the law is that any transfer that you make to a spouse or son's wife is going to be clubbed in the hands of the person transferring. However, here it is important that if the income, for example, in the first scenario where I was getting a salary or a commission, etc., from the partnership firm where my husband was having more than 20%, but the remuneration was because I was working in my professional capacity as a chartered accountant, and that is why I was getting arm's length remuneration, then there should not be any problem of clubbing. What we have seen practically is that in most of the family-owned businesses, what they do is everybody gets salary from the business. And we see problems when there are surveys or search actions. When the women members are also interviewed by the departmental people and they ask them all practical questions about the business, and that is when it is very evident that they have not been participating in the business and they are only getting salary for not being family members rather than for actual work or experience or knowledge. That is when the problem is more acute. Normally, so long as we are able to demonstrate that the person has the capacity, so it's not necessary that you need to have a chartered accountancy or other professional qualification. So if a woman member of the family, a BCom or somebody who can handle HR is looking into the HR or the administrative aspect of a partnership firm of the family, and it can be demonstrated that she is independently working and is giving services, then there should not be any clubbing of it. And this is very important. What has to be clubbed is income on account of transfer of an asset. Any income earned on that income. Say, for example, 10 lakhs rupees salary was given to wife of the partner. The department alleges that this income is to be clubbed in the hands of the husband. Good enough. The 10 lakhs gets clubbed. However, the wife had invested that 10 lakhs in an FD and earned 6% interest of 60,000 rupees. That 60,000 is not going to be clubbed in the hands of the husband. What is to be clubbed is the first incidence of income and not the income earned on that income. So it's not cascading effect. Only the first incidence of income is to be clubbed in the hands of the spouse. And again here, as we saw, I know we didn't see, in this case of Gotla's case, which we discussed earlier, when it comes to clubbing, you have to club both positive as well as negative income. So if an asset is transferred to the spouse and then on sale of that asset, there is a loss, then even the loss has to be clubbed in the hands of the transferor spouse, and he will be eligible for set off and carry forward as per the other normal provisions of the law, as if it was his own income. Income from assets versus income from alienation of assets. So you have transferred some asset to the spouse, as we discussed in the earlier example. There is capital gain and there could also be income which would have come on that, say dividend. So both have to be clubbed. Second is for clubbing, the relationship between the SSE and the transferee should exist on two dates, the date of transfer of assets and then when the income arises or accrues to the transferee. So say for example, after the transfer of asset, there is a divorce. Then post the divorce, there should not be any clubbing of income, although the asset continues to be held by the spouse who is no longer, or the ex-spouse. It will stop when the relationship has ended. So in case if the salary is to be clubbed in the hands of the spouse, the net income after standard deduction should be allowed, is what one of the case laws says. And income due to accretion of assets transferred for inadequate consideration cannot be clubbed. Say for example, shares were given and then on those shares the spouse received bonus shares. Then those bonus shares cannot be clubbed, or the income from those bonus shares cannot be clubbed in the hands of the transferor spouse. Now, clubbing of income of minor children. So we all are aware that income of a minor has to be clubbed in the hands of the parent who has higher income, so long as the marriage continues or subsists. If unfortunately the parents have separated, then the income of the minor will get clubbed in the hands of the parent with whom he is living, or who is the guardian parent. Now, while generally all the income of a minor child would get clubbed, except there are 3 exceptions. If the child is suffering from any disability of the nature which is specified in ATU, there are a list of disabilities, autism, etc. And if the child is suffering from such a disability, then his income will not get clubbed in the hands of the parent. Or if the minor child is getting something on account of his own manual work. So if he has done some work, I don't know whether manual work practically would happen considering you have laws against child labor, etc. But if in any scenario, the minor child has earned something on account of his own labor, that income will not get clubbed in the hands of the parent. Or if he has earned something out of the application of his own skill, knowledge, talent, or experience, say a child who is acting in serials or movies, or a child who is good at maths and is appearing in shows and doing some reality shows and is getting some income. All those income which is attributable purely to his skill will not be clubbed in the hands of the parent. It's already 6:13. Let me know when I have to stop. I'll quickly go through this. Now, there is a very small exemption which is available of 1,500 rupees to the parent. So if 10,000 rupees are getting clubbed, you get a deduction of 1,500 rupees and 7,500 will get added in the hands of the father. Now, there is one typical scenario where, what if there are cross gifts? Say if a husband gives to the spouse, then the income of the asset gets clubbed in the hands of the husband. Now, somebody could make an arrangement where 2 brothers do cross gifts. Each brother gives to the spouse of the other brother. There are case laws which say that this whole arrangement was only to avoid the clubbing provisions, and so this is not acceptable and the clubbing would continue. Sorry, your respective spouse should have been the word, not fathers. Income of individual to include income of spouse. Now 64.2 continuation. Now we are coming to clubbing in case of HUF property. So if a person who is holding his personal property puts that or converts that property by putting it into the HUF, into the hodgepodge of the HUF, and converts into a HUF property, the income therefrom will continue to be taxed in the hands of the transferor. In the second case, if somebody has put some property into the HUF, thereafter the HUF is dismantled and the spouse of the person receives the property. In that case, whatever income that accrues on the asset which has come to the share of the spouse of the person will now start getting clubbed into the hands of the person who had contributed it to the HUF. So here they are ensuring that even through the HUF route, you don't transfer any asset to the spouse. And it gets clubbed if some such arrangement is done. So we are done with this. I was just wanting to know, should I continue quickly with this chapter 6A deductions?
Ma'am, we can run with slides and give a brief.
So actually, frankly speaking, there is not much to cover. Here
Mhm.
there is chapter 6A in the new regime. The new regime, which is now like the default regime, as they had said in the budget speech. There are only 3 deductions which are available. One is 80CCD, where and that too employer's contribution to in NPS of a employee. So if an employer is contribution to an employee's is contributing to an employee's NPS account, up to 10% of the salary is allowed as deduction under 80CCD. So first that 10% becomes part of the salary, and then you get a 80CCD deduction. So that is the benefit which still continues even under the new regime. Second is the one where 80CCH, there is this Agniveer Corpus Fund which is created, where the Agniveer will also contribute his share. Government will also contribute. So here they will get deduction under 80CCH of chapter 6A and 80JJAA. This is a deduction which will continue because they wish to promote employment. So as we all know, this is an old provision where any incremental employment that the business generates, they'll get a deduction of 30% for 3 years of the incremental salary payment. Subject to the conditions, it has to be a business undertaking which is subject to audit, total number of employees are more than the total number of employees in the preceding year, and a certificate by CA is provided. And then the conditions that what should not be done are prescribed. So these are the only 3 deductions: 80CCD subsection 2, 80CCH subsection 2, and 80JJAA are 3 provisions under which the deductions are allowed under chapter 6A even if you opt for the new regime. Then this is just a laundry list of other sections. I have not listed out those which are 80IA and all those complex sections. I only listed out those which are generally applicable to individuals. All these are applicable only if you are opting for the old regime, that is continue to claim 80C, invest in PPF, etc. And you can claim all these deductions under normal provisions, subject to the fact that your slab rates will be different from the ones under the new regime. Sometimes we miss out on claiming this 80GG deduction, where you are eligible to claim deduction if you are paying rent. And 80QQB, which is for royalty. If you're an author and you're getting royalty amount, then you are eligible to claim deduction. Others for disability, if you give to political party, you get 100% deduction, etc. So exemptions, I have just listed out some of the routine exemptions which are available under the Income Tax Act. So I will share the slide. I don't think we need to go through this laundry list of section 10 exemptions. Okay, thank you very much for giving me this opportunity.
All right. It was indeed a wonderful session, ma'am. Let me check if we have questions. All right. So everything was crisp and clear. So thank you, Toril ma'am, for enlightening us with vital aspects of these important provisions of clubbing, set off, and carry forward. Speakers like you are truly valuable to our society. So we would definitely like to hear you again. Thank you, ma'am.
Thank you for the opportunity. Thank you very much.
I would also like to thank our chairperson, CA Preeti Savla ma'am, CA Abhay Chajed sir, Vice Chairman, Women and Young Members Excellence Committee, and also our young coordinators of today's session, CA Swarupa, CA Suchita, including me. Thank you all. Thank you for attending the session.